What's the biggest hard deposit you've put up day one?
I think 500,000.
That's a big boy.
Yeah.
Balls, ginormous balls.
3, 2, 1,
We have a billionaire in the making in our room today. Rob Beardsley, welcome to the show. How you doing?
Thanks for the hospitality. It's great to be here.
Awesome. So, Rob, I'm just going to give a quick background for the audience that don't know you. Rob Beardsley is the founder of Lone Star Capital. He is 26 years old, a college dropout, and he has acquired over $400 million of multifamily properties. Has developed his own proprietary underwriting models and sold over 10,000 copies of his book, The Definitive Guide to Underwriting Multifamily Acquisitions. It really is an honor to have you here today, Rob. Can you just kind of jump right into it and tell the audience just your background, how you got started in real estate, and just your story, man?
Sure, would love to. So I grew up in Northern California in Silicon Valley in a real estate family. So growing up, my parents ran a residential brokerage firm from home, buying and selling luxury homes for their clients and also doing some fix and flips and development on the side. So I was exposed to real estate at an early age, but it didn't necessarily develop a passion for it until later on. And that was because I saw my parents struggling, not necessarily loving their work, right? They were struggling. They were kind of caught up in that middle class crunch where they're making a lot, but also working a ton and having a lot of expenses and all that good stuff. So what they showed me was all the tech success around us. And they said, look at all the startups, look at all these people that went to Stanford and Harvard and are in the tech space. That's what you want to do. That's where the exciting money is. So I kind of followed that path. I went to school for computer science. I definitely enjoyed school and that sort of education, but somewhere along the way in college, I just caught the real estate bug, and it just clicked for me. And the real click was going from single family to multifamily, because seeing my parents run their single family business and buying and selling homes to their clients, chasing commission checks and not actually building assets or wealth, that whole thing didn't resonate with me. But then when I got exposed and learned about the multifamily business model, which is much more scalable, much more institutional in sophistication and its nature, I could definitely resonate with that more and grasp onto a long-term vision of building a multifamily business and portfolio and growing wealth over time. So that was kind of the start of the multifamily journey. And then, as you mentioned in the intro, things escalated rather quickly. Met my business partner, ended up putting our first deal under contract and dropping out of college shortly thereafter. And then from then on, it's been off to the races.
That's awesome. That's awesome. What was it that sparked it? So you're seeing, buying, selling single families, and then all of a sudden you dip your toe into multifamily. Where did you have a mentor? Did you how did that all start?
So I had a good combination of baseline real estate knowledge, right? I actually knew a lot more than I gave myself credit for because of growing up in my family. So I knew more than most people. So I had a basic understanding. And then obviously going from single family to multifamily it's just 1 to 100, right? It's not that much more complicated. And then the other big element was just being young and naive, right? I didn't have these thoughts of, I can't do this, or I'm not ready, or I don't know. I was just kind of confident for no reason, right? Naive and just ready to jump in. So that's exactly what I did. And fortunately, I worked with a mentor, Joe Fairless, he was big at the time, but he's grown in his kind of brand and reach much more ever since. So I kind of got in with him at the right time when he was big, but not too big, able to join his mentorship program, meet a lot of people. And through that program is actually how I met my business partner, Kent, who we started Lone Star together with. So it was very, very lucky, how one thing led to another.
This is, I think, like a trend. We keep seeing people join these masterminds and finding their business partners and sparking their passion, and then also having those resources. I mean, it sounds like that was a huge reason that you were able to, I guess, scale so quickly?
Yeah, and aside from just the young and dumb confidence, also being with a mentor and being with a support group like that, and talking with someone like Joe or another mentor who's been there, done that, and has the confidence, that just gives you the confidence as well to move forward and know that everything's going to work out, because there is a lot of risk and a lot of you're taking big leaps of faith when you're getting started in this sort of business, because if you're going from never investing in real estate to then buying your first property at over 200 units and $20 million, that's a huge leap, and there's so many gaps in your experience and knowledge that you need to fill with partners. And so that's certainly I take no credit for our first deal or any deal, because there's so many people involved to put it together, and that's how we make it work.
So how long after your first deal? Well, I guess I'd love to hear about your first deal, but also at what point were you like, screw it, I'm quitting college and I'm going all in?
So it was somewhat of a gradual process, and I didn't force the issue. It was kind of like it forced me, where I had built up enough responsibility and had enough things going on to where I was spending a lot of time outside of school doing work stuff, to the point where I'm being pulled out of an accounting class because I'm getting a phone call about this deal or about this thing. And it's like, well, I need this. There's more important things than accounting class, right? I've got real accounting going on. So it was a gradual process, and I knew that once we put the first deal under contract officially, I knew that it was, I had full go, full credit to just go ahead and go for it. And even my advisor was advising me on it. So it wasn't like this big dramatic moment where like the college is hating me or my parents are disowning me. It was like a rational, reasoned process to where my advisor said, yeah, this seems like a good opportunity for you. You should take the risk. If you fail, you can come back. And same thing with my parents. My parents were, definitely they would prefer to see me finish school and get a degree. That's kind of like a proud thing for a parent. But they have always supported me. So the only thing that was harsh, if you will, was basically like, hey, if you're no longer college student, then we're not going to treat you like a student anymore. You're an adult now, and you're on your own. So it's not like, oh, you get to just play this fairy tale thing of try this business opportunity. Nope, you're a real adult. You need to go make it work. And I appreciate everything they've done, and I appreciate that as well.
Wow.
Sink or swim.
Yeah.
Burn the boats, baby. I love that. I mean, I'm curious. The syndication business isn't. It's really like a long-term wealth play. You're generally not making a ton of money up front, on these deals. So when you're making that transition, your parents are like, okay, you're on your own. You still got to make money to pay the bills, right? But usually you're not making a ton of money up front on these deals. How did you float that, and how did you manage that transition period before you start actually really making money?
Right. Yeah. So again, goes back to my parents and my family. Super fortunate. I was able to move home, live at home, have no distractions, no expenses. And I have this one picture in my head of me sitting. I co-opted the dining room table, and I put up a couple monitors, and I had my setups. I just was there, and I was just putting in 12-hour days, just building everything. And it was such an exciting time. So that was the bridge to make things happen, as far as you're not making any money and you need to survive and stuff. And it's really a crazy thing, because if you're starting any business, I feel like you need a minimum, if you're lucky, 6 months, but could be even 2 years of where you're just not making money, and it's just tough. And if you already have a family, a mortgage, real life expenses, I can't imagine the stress that you'd go through to try to transition. And that's why I respect my business partner, for example, so much, because I was the one that dropped out of school, but he was the one that left a very high-paying job that he's a senior tax attorney for 12 years. And for him, leaving his job was leaving income to now how is he going to transition and support his wife and children with couple mortgages. He had like an established life, so that's a completely different risk. And so I feel like he's never really heard me say this, but I feel like in those early stages, I feel like I played the role of co-founder as well as therapist, because it's emotional, right? And it's a roller coaster. And so both of us would lean on each other emotionally, not just work-wise, to get through the very difficult times that inevitably all business owners go through when they're starting a company.
Yeah, I think I was actually just talking to my girlfriend about this yesterday. She wants to get started in a business, and I was like, you're at a point in your life where you don't have a mortgage, you don't have kids, you don't have car payments. Like, you're never going to be in a better opportunity to do this than you are right now. And I think it brings a good point. Luckily for you, you could go home. I mean, we didn't make money for our first 6 months in business at all. And we did the same thing. It was like, dude, are we ever going to make money? This is crazy. But it sounds like you had a really good support system around you that kind of allowed you to take that leap.
Yeah, we had a lot of fortunate things come together. Obviously my family support, and then my business partner. The timing was really good with his job because they were kind of consolidating different departments and stuff. So they were looking for volunteers for people to either move or retire, essentially. So he was too young to retire, obviously, but he was, he's able to raise his hand and get a nice severance, which was a good 6-month bridge there.
Wow.
And you're totally right. The time to take the risk is when you're younger. Picking up the pieces is much easier at that time.
That's awesome. I know you have more technical questions, but I love this story, man. This is awesome.
I do have one more story question. You said you caught the real estate bug. When did you discover real estate, and how did you find the bug?
There's people out there who get the concept of delayed gratification, and then there's people that don't, right? And real estate is so much a delayed gratification game. Really, all investing is, right? Because if you explain to somebody the idea that you could put in $100,000 and get an amazing cash flow of, let's say, $8,000 per year, right? 8% is very good. A lot of people who don't understand, they would go, hey, is that really worth it? Like, why would I give up my 100K to then only get 8,000 per year, right? A lot of people just don't understand that concept. So for me, fortunately, I've always lived through the delayed gratification paradigm. I've always enjoyed the process of putting in the effort and reaping the reward later, whether it be in the gym, in school, in sports, in life. So that part of real estate I grabbed onto. Then from there, it's just really all the logical reasons for why real estate is such a powerful asset class. Like, I'm a very pragmatic, logical person, and here are the things that I like about real estate. One, it is a cash flowing asset, and you can value it by its cash flow. That's amazing. Number two, tax benefits, right? That is just such a no-brainer and a huge, huge factor that just adds another powerful element to real estate. And then I would say number three, which is kind of controversial, is illiquidity, right? In the stock market, you can buy and sell every second. So, and actually I had some experience with that, because also in college, before I fully went all in on real estate, I was thinking, oh, well, I'm going to invest in the stock market and I'm going to trade and do all sorts of stuff, right? I wanted to make money. And, I got my butt kicked by the stock market. It's so stressful. It's so tough. And it's just not a pleasant experience. So the fact that real estate is illiquid, and it's like when you own a building, there's not the price tag on the building like changing every second out front, right? When you own a stock, if you own Apple's stock, right, going up and down every day. So I like the illiquidity nature of real estate, where it's more of like set it, forget it, Warren Buffett style, invest for the long term. And that is also more conducive to that delayed gratification, long-term wealth building.
It also creates opportunity, right? I mean, the fact that it's illiquid and not everybody can do it lends opportunity to people like us that can, find these assets that are underperforming and then, add value, right?
Right. There's not many inefficient markets out there, right? The world has gotten so connected. Knowledge is so distributed. The stock market is very efficient, right? It's very difficult to find the hidden opportunity, like you mentioned. But in real estate, it's still very possible. Yeah,
those are three really, really great points about real estate. And I think what you said about the delayed gratification. That's one of my favorite things. I don't know if you know the Stanford study, the Marshmallow Test, right? 1 marshmallow now versus 2 later. It sounds like you were always like a 2 later kind of guy.
For sure. Yeah, I love that test. Actually, yeah, it's a good one.
So, as an author of the definitive guide to underwriting multifamily acquisitions, and myself being a former private equity real estate analyst on the acquisition side, I think it's my job to ask you some difficult questions. There's a lot of economic uncertainty. How are you underwriting your deals to ensure that your investors are getting an attractive risk-adjusted return while staying keen on capital preservation?
Yeah, I think the biggest factor to that success there is on the debt side of things. So in today's environment, we've shifted pretty much completely to focusing on long-term debt of 7 years or more. It's about 7 to 10 year debt. I think 7 is plenty, but some people even like 10 years as pushing out maturity risk and really just locking in a long-term fixed rate debt. So for us, it's kind of controversial because some people feel like, well, if interest rates are already high now, you might as well just float today and you can float lower tomorrow. So that's the pro floating rate argument. For us, we feel like fixed rate's the way to go for 2 reasons. Number one, we can lock in interest rate savings today, right? Right now, we have a very weird market where the yield curve is inverted, and it's deeply inverted, and it has been for a long time. So what that means is it's actually more expensive today to float than it is to fix, right? Normally, that's not the case. So by fixing, we can reduce our interest costs today, which what are we most concerned about as far as cash flow is today's cash flow, right? So if we can reduce interest costs today and then lock in that rate for the future, that provides the certainty that allows our investors to sleep at night. So, we've learned over the years with different experiences and trying to make deals as best as possible, what we've realized is it's not always about pushing for the highest returns for our investors, because while our investors appreciate that, what they appreciate most is consistency, certainty, and the ability to sleep at night. And me too, right? As a business owner and managing the portfolio and having to answer to our investors, I would much rather have a more stable operation, right? So that's something that has become more and more important to us as we've gone through these different experiences and rising interest rates, and we've been chastened by difficult experiences. So yeah, to answer your question today, definitely 7 to 10 year fixed rate loans, because if the interest rate works for you today, it'll work for you for the next 7 years. Maybe rates go lower and you could benefit from a lower rate, but so be it, right? Locking in that certainty is most important.
Got it. We're taking out a loan right now, a Fannie Mae loan that's 7 years for that exact same reason. And where I'm stuck on is, should I go with a 5-year yield maintenance and 1% on the last 2 years, or a 7-year yield maintenance? What are your thoughts on that?
Yeah, so we've done a ton of 7-year Freddie deals actually with 5-year yield maintenance. So the same concept applies, right? That's the sticky thing that a lot of people don't talk about when they talk about fixed rates. Right? You see a lot of people on LinkedIn or wherever talking about, oh, long-term fixed rate debt, right? I'm conservative. But what they don't talk about is the fact that you often have nasty prepayment penalties, right? Like yield maintenance.
Mm-hmm.
And that can be very detrimental to your deal, especially considering the fact that, who knows where interest rates go, but if you believe that interest rates are relatively higher today and you think maybe the 10 years is going to come down over the next couple years, that's going to impact your yield maintenance prepayment penalty even more, right? Because those are inversely correlated. So the lower the 10-year goes, U.S. Treasury yield, higher yield maintenance payment. So
Right.
For us, we've been choosing more so the 5-year yield maintenance for a couple of reasons. One, because when we were doing the last couple Freddie deals, it wasn't that expensive. And for those that aren't familiar with how that prices, the lender adds an additional rate, an adder to your interest rate in exchange for a lesser prepayment penalty, right? So it's just math, right? If the adder is only 25 basis points, that can definitely be worth it to be able to exit in the last couple years for free, or like you said, for a 1% prepay, right? And there's multiple options, right? You can have 5-year yield maintenance, and then the final 2 years are a 1% exit fee or 0% exit fee. And so it depends on the pricing. So for example, we did a lot of deals with 5-year yield maintenance and then open at par for the last 2 years. So no penalty, which works great for our underwriting, right? Because if we forecast out a 5-year hold, that means when we sell after 5 years, we sell with no penalty, right? So that's nice, because if you have, let's say, 6.5-year yield maintenance, kind of like a more traditional deal, then you have to figure out, okay, well, if we're underwriting a 5-year hold, which is most common, what are we going to project the prepayment penalty to be, right? It's you're taking, I mean, with yield maintenance, you're always taking market risk, but at least if you have the last couple years at 1% or par, you're creating a bit more certainty for yourself. So that's been our angle. We've preferred the no penalty at the end. However, we're doing a deal right now, and the difference between 1% prepay versus 0% for the last couple of years, I forget, it was a lot. It was like another 20 basis points or something just for that last couple of years to be open. So I'd rather just pay the 1% down the road than an extra 20 basis points every year, right? So it's all math.
That's a great answer. Thank you. The underwriting, you built your own proprietary underwriting model. I mean, you must be like a savant at underwriting. I'm wondering how are you running? Are you doing how are you modeling your cap rate expansions? Are you doing any sensitivity analysis? Can you kind of speak on that?
Yeah. So exit cap rates are always a tough one because they influence the projection so much, right? And also the funny thing about it too is it's a sticking point for investors. Like it stands out. It's going to be one of the first questions they ask if they're looking at your model. Well, what are you projecting, right? So for us, we have to be mindful that we don't want to be too aggressive on the exit cap rate. However, if we're too conservative, we're just going to lose out on the deal. So my philosophy here is a little bit nuanced. Number one, the reality is if you want to win deals, you have to be aggressive somewhere in your numbers because you're competing against other bidders and they're being aggressive too, right? That's just the nature of the market. So our philosophy is if we're going to be aggressive anywhere, it's better to be aggressive on the exit cap rate because that's down the road and that doesn't say anything about our operations. What I would hate to see is us be too aggressive on expenses, for example, because day one we take over that property and we're underwater right away, right? We're wrong on expenses and every single month we're getting burnt because we thought expenses were going to be here, but they're actually here.
That's smart.
So for us, I'd rather let's be conservative on our operations, revenue, expenses, and then let's be optimistic about the future growth, the exit cap rate, because why else would we be buying in the quality areas that we're looking to buy in, right? It's because we want that growth. It's because we want that cap rate compression. So that's kind of the high level philosophy. And it sounds great, but when the rubber meets the road, it's obviously easier said than done, right? It's not often realistic when you can just put an exit cap rate of like in today's market, 5%, right? That's tough. Obviously, this is so market specific, so people shouldn't read too far into these specific numbers. But I guess the point that's most interesting today is the fact that I'm seeing more and more people actually underwrite no cap rate expansion because they feel like cap rates are at a relatively higher today, and that's driven obviously by all the market factors at play. So yeah, I mean, we're kind of moving in towards that camp of, normally we just say, hey, we'll expand 50 basis points over the prevailing cap rate. Mm-hmm. But I think in today's market, that is maybe not as useful.
I think that's really smart because, I mean, if you're conservative on your expenses and revenues, right, you're still going to be able to pay out your preferred returns and give the investors, what they're expecting, and you're not going to be in jeopardy of going underwater on the deal. Worst case scenario on the back end that 18% IRR turns into 15 or 14, and the investor still gets their money back and made a nice return, right? I think
exactly. Yeah, it's a different type of risk, right? You have risks like the biggest risk that you want to avoid always, of course, is loss of capital.
Right.
Right. And so what could cause loss of capital? Well, it's getting foreclosed on. It's not, if you can't make your debt payments because you're wrong on expenses and stuff like that. Right. But the risk of it being a 14% return instead of an 18% when it's all said and done, that's a risk I can live with for sure.
That's really smart. I like that a lot.
Yeah, and if you're being conservative on your NOI and you outperform that, you're going to balance out at the end. I'd like to know, out of personal curiosity, your underwriting. To make sure that your operating expenses and your income are conservative at time of acquisition and throughout the hold period. You must have to do a pretty significant amount of due diligence. What does your due diligence look like?
So when we first look at a deal at a high level, just kind of the desktop underwriting, it's very standard, right? I mean, similar to everybody, we look at the comps. Fortunately for us, and this kind of feeds into this, is we're very focused. We're not in every market, and we're not buying all sorts of different kinds of deals, right? So that allows us to be experts in the deals that we're looking at, which makes it so much easier to actually put in the projections, right? Because we've seen that deal before, and we know how it runs, and we have properties in the portfolio nearby, and it's very easy to underwrite expenses, right? And then on the revenue side, it's just really all about comps. And so our team, nothing sexy here, right? We call the properties, we call the comps, ask them what their specials are, ask them what their other income charges are, what the rents are today. We try to get as much information as we can. And then, of course, we use all the online data available to us as well. And comps are really, that's the part that's time consuming, but also extremely important, because as we all know in this room, $25 difference on your pro forma rents, that's a big impact. So being able to go out there and survey the comps and figure out where the value is, and really try to figure out, can we push the rents where we want to take them, because that's where the business plan value is. That requires a ton of time through the comps. And then from there, again, I don't think we do anything that special. We do our, so I guess something that is maybe a bit unique to us is, because we've pretty much always operated in a competitive market, and I think for as long as Dallas and Houston exist, those are going to be competitive markets. We go hard at the signing of the contract, which means when we put down the deposit, we go non-refundable on that deposit the day we sign the contract, right?
Wow.
And the reason why we do that is it's pretty standard for the market, frankly, which is very annoying. But to the extent it's not, it differentiates us as a bidder. And so if we can show up to the table and say, all right, here's our price, here's our terms, we're going hard day one, here's our reputation, that speaks very loudly to the seller, right? And that's our way to win deals. And we've won deals by being the highest bidder, obviously, and we've also won deals by not being the highest bidder, because we were able to leverage our terms and our reputation. So the reason why I bring that up is because going hard day one's very scary. So you want to be very sure about your due diligence and that you're right about the deal. So the way that we get comfortable is we ask for an early access agreement, and we come in with our team and we inspect a random 10% of the units, 10% of the lease files in the office, and then we do an exterior site inspection with our GC partners. So not every seller agrees to all of this. Sometimes they push back. Maybe they don't make it a random 10%. Maybe they want to pick the units. Maybe it's just vacants. So it's an arm wrestle on that, but I would say that is our somewhat unique DD approach that gets us comfortable going hard and gives us that ready insight to where we can quickly in a day, all right, let's do this thing.
I love that.
Yeah, that's great. And I think probably having done that, when you make your offer, the seller, I'm sure, feels a little more comfortable now that you've already been there and inspected, and you're not just putting out an offer, right?
Right.
I mean, does that ever? I mean, you're in a competitive market. Speed's probably the name of the game. Are you losing opportunities because you're asking for that?
It's a good question. you know, supposedly there are other buyers in the market that are willing to go hard and not do any
Right,
sort of
At all.
early access or anything. I don't know. I mean,
I think that's really generous. 10% random.
I think it's a great compromise.
Oh my
You know,
gosh.
we're not disturbing the property too much. Everything's fine.
Genius.
Yeah, it's really great.
It's incredible.
And you know, it's a spectrum, right? And also it kind of depends on maybe where you are in your career or how aggressive you want to be. Because I'm familiar, and I was actually, what comes to mind is when we were selling a deal a couple years ago, I remember we were conducting buyer interview calls, right? So now I'm on the other side of the table, right? Not as the buyer, but the seller. And I'm listening to the different buyers pitch us on why we should pick them, right? And I remember being on the phone with this Canadian private equity firm, and they have $2 billion under management. So, you know, they've got the capital, they have the experience, but coming down to Texas was new for them. And so while they could make all the assurances to us that, hey, we have proof of funds, we've got this big portfolio, we've got this name, they were not willing to go hard day one, right? And so as a seller, even though I recognize them as a big company, the fact that they aren't willing to go hard day one puts me at risk of, well, maybe they just go under contract and waste 30 days of our time, and then we have to go back and pick another buyer, right? It's risky for many reasons to do that as a seller. So in the end, we picked the local group that was much smaller. They didn't have the money ready. They had to go syndicate, but they were willing to go hard day one. So it just shows you kind of like, doesn't matter if you're big or small, everyone has a different philosophy on whether they're willing to go hard or, you know, different buying strategy.
A question on the early access agreement. It's just one day. You ask for one day to just randomly pick a couple leases to look at, try to match it up with the rent roll they provided, and then go to the units, make sure it doesn't look crazy. Okay, it's just a one day thing.
It's a one-day
That's
thing.
freaking it's beautiful, man.
We sometimes do it before actually signing the contract, and then it's whatever the seller wants, right? We're flexible. We just want to protect ourselves as best we can. But what I think is really elegant is, so what sellers also don't like as far as early access or anything is obviously time, right? Time kills deals. And when a seller is picking a buyer, they're taking buyer risk, but they're also taking market risk, because if that buyer fails to perform, and they go back to the market might be different by the time they go back, right?
Yeah.
And aside from the market, there's also the stain of a failed deal, right?
Yeah.
All of a sudden the buyers go, well, what happened with that deal? Or what did they see that's wrong, right?
Right.
So I get why the sellers are concerned. So as far as the timing, we tell the seller, all right, we're going to negotiate the PSA as we get geared up to do our early access. So we're not slowing things down at all, right? Let's negotiate the PSA, then let's sign it, then let's do the early access, and then we'll wire the funds. And it's just a one day thing, right? So that's how I like to do it. But you know, again, we've structured it many different ways just to get the deal done.
Yeah.
What's the biggest hard deposit you've put up day one?
I think 500,000.
That's a big boy.
Yeah.
Balls, ginormous balls.
Beardsley
Wow.
balls. That's what it takes.
Yeah.
I think that's going to kind of take me into my next question here. How are you structuring these deals, right? I know some syndicators are, partnering with another co-sponsor to put up the hard deposit. There's people that work with co-cap GPs, work with a balance sheet provider, KPs. How are you structuring your deals? You're 26 years old. You've bought $400 million worth of real estate. You must be a master at getting these deals done and working with other people. So I'd just love to know, structure and how you do it.
Yeah. So I think this is an awesome topic, and I think it helps to look at it from an evolution perspective, because going back to our first deal, I remember thinking to myself, I literally don't care how much money I make on this deal, or in particular the acquisition fee. Just getting the deal closed is a huge win. So I had no ego, and I was not selfish at all, right? Whatever partners we had to bring in to get the deal done, that's fine. And you alluded to a few, just a second ago. So when you're getting started, right, most likely you're going to need a loan guarantor, probably need someone to help you put the initial deposits down and the lender deposits, right, all your risk costs, risk capital. So that's exactly what we did when we first started out, right? We went to investors, borrowed money to put the earnest money deposit down. We brought in a loan guarantor to satisfy the lender, brought in a property management company, and then brought in people to help raise capital and made it work, right? That's oversimplifying 6 months of my life where it was very stressful and scary and, scared to lose money and stuff, but that's how we got it done. And so starting from that point and growing to today, which I'm extremely proud of, is a slow process of slowly being able to do more and more and more of these elements on our own, right? So over time, we've built up the capital to be able to put these deposits down on our own. Okay, fantastic. Now, number two, we've also built up the experience, the net worth, and the liquidity to be able to actually get the loans from the lenders on our own account, right? And don't need loan guarantors. That, like, when that started happening, that was just such an amazing, coming out party. It was just so great to be able to do that. Not have to worry about loan guarantors, right? So, and then up till today, we still very much so work with a lot of capital partners that help raise equity. Raising equity is the hardest part of the job, and our ambitions will always be bigger than our wallets, right? So we'll always want to do bigger and bigger deals, which will always require to bring in more and bigger partners. So that's kind of at a very high level how we structure deals today, which I know is very oversimplified. So if we want to go deeper on anything, let's do it. So yeah, that's where we're at today.
Yeah, let's dig in. Let's dig in. So you had a big You had a big party after you could, guarantee your own loans. You didn't need someone to balance sheet it. Why? Why does that make an impact to you financially?
Yeah, great point. So when you bring in a loan guarantor, obviously they're taking a risk by signing on the loan with you, and they need to be compensated for that risk. So there's different relationships, there's different arrangements that people have when it comes to that. And I've actually been a guarantor for others now as well, and kind of over that as well. It's stressful, and you're not totally in control. It's another thing to worry about. So I totally respect and understand where a loan guarantor is coming from, but we've had to give away 20% of the GP to a loan guarantor, right? And that's a big bite. So that's really the main motivation, right? Aside from money is the really important part, and then also just kind of the pride and simplicity of like, this is our deal, we're signing for this deal, having that ownership, total ownership.
Got it. As far as putting up your own deposits, right? When you had the liquidity to put that down, what were you paying previously to investors?
Yeah, it's varied a lot. We've had investors who were kind enough to do it for free. That's really nice.
That is great.
That's really nice. That's the sweet spot. So if anyone listening is trying to set that up,
Free.
you need some
Free money.
very very kind investors. But if you have an investor who is interested in investing in the deal, you can say, okay, that's great. Are you willing to put the initial deposit down as your investment? And in exchange, we'll give you maybe a kicker or a bonus or whatever. So actually, free is not right, because now that I think about it, we actually paid him $10,000, which is basically free, right?
Yeah.
For the risk and everything. But we also did a personal guarantee on the funds as well. So, I mean, I think you just scrap and you do whatever you can, and it's all about, as cliche as it is, it's all about your network, right? Access to capital of all different kinds, whether it be balance sheet money or risk capital or equity. I mean, that's what makes the business grow. So we fortunately have been pretty lucky with the access to capital that we've had on all those fronts.
Fantastic. So on the deposit side, you've paid like a percentage on the money that they gave you. Have you ever had to give out equity on the GP side?
I think once. And I think that was actually to my parents.
Okay, gotcha. Well, it's good to give
It's
back
good to
your
be
parents.
generous. Generous to the parents.
There we go.
They deserve it, man.
Yeah.
They seem like good people. Okay, so what's one piece of advice, or just advice in general, you would give to a syndicator looking to scale up their capital raising operation?
The capital raising operation is super important. So, I mean, first things first is whoever's asking that question, I'm glad they're asking that question, because when I started, I didn't even ask that question. I just was ignorant and had the hubris to assume that, well, if I find a good deal, I'll be able to raise the money, no problem. Right? And that's so stupid. The reality is there needs to be someone on your team that is basically full-time committed to capital raising efforts.
Mm-hmm.
So that's step number one. Step number one is realizing the importance of it and committing to it. And then number two, in my opinion, would be playing the super long game, which is thought leadership. Because we're in a very special time where you don't necessarily have to do everything one-to-one, right? I have mentors who've been in this game for decades, and they talk about when they were starting in their capital raising journey, it was all about one-on-one meetings, right? Taking people to lunch, taking people to dinner. And that's I mean, if it works, it works, but that's terribly inefficient, right? We are in an age now of social media and online marketing where you can go one-to-many, and that's so much more efficient and scalable. So I would urge people to consider the one-to-many approach and to commit to it, because the reality is, whether it be this podcast or writing a book or a blog or whatever, it pretty much takes 2 years of no results to start seeing something, right? And that's very difficult. It's very difficult to stick to anything for 2 years on the hopes that you'll get results, but that's the reality of it. So my advice would be, look at the long picture and just start investing in your one-to-many strategy now.
Can you give some examples of like a one-to-many strategy that I could implement today?
Yeah. Well, you guys are doing this podcast, which is huge, right? I think that's super smart. And, looking around at the equipment and everything in the room, this is not cheap to do, right? This is an investment and it's a commitment. So I think that is super important to add on to it. So something that you might not be doing is having a lead magnet, right? Like you mentioned the underwriting model that I built, right? That was something that very early on I strategically decided to give away on our website for free. A lot of people were saying, well, why don't you sell this thing? Other people are selling it. I would pay $250 for that, and you could make a lot of money selling this thing. And to me, it just didn't resonate. I didn't feel good, or didn't feel like it was the long game. Like maybe in the short term, I could make 10 grand by selling this $250 model or something, right? But the long game I thought was much more valuable. And by giving it away, that model's been downloaded well over 10,000 times, and that's grown our network exponentially, right? So I would consider what you guys might be able to put together or already have that you use on a daily basis that is valuable, that you are willing to give away for free in exchange to collect people's emails, right? Collect people's emails, grow the network, and that's just the start, right? Collecting someone's email doesn't automatically nurture them into an investor. It's more work from there. I've been writing a monthly newsletter for 5 years now, and it's just every single month got to write an article, and the better the article, the more people are going to talk about it, respond to it, and share it. So it's kind of it's definitely a labor of love, and like I keep saying, the long game.
I love that.
That's a great idea.
I love that. Yeah, I mean, this is honestly, you're spot on. This is stuff we've been talking about because we have this ecosystem. We had a Deals and Dollars event that was amazing. We had 400 people there, and it's like the most talked about event. And it's like, well, what are we doing with all these people, and like where are we pushing them? And I think you're spot on. And clearly, for you, the hard work's paid off, and you can see it. You're all over the place. So hats off to you. I'm curious from my own standpoint, 400 million assets under management. I mean, incredible feat. What does the team look like for you guys right now?
Yeah, we have 7 people on the Lone Star team, and then we also have Radiance Living, which is our in-house property management arm that's based in Houston. So we've got headquarters, Lone Star in New York City, and then Houston is where our management team is. And the management team in Houston has, we have our VP of operations. I think at this point, we're in the process of hiring, so we've got maybe 3, hopefully getting to 4 regional managers to oversee the different portfolios in Dallas and Houston. And then, kind of like regional maintenance supervisor and different stuff like that. And then at the corporate level, here in New York, we have our acquisitions team. We have our investor relations. You guys met my sister. She handles investor relations and investor services. Also very cool, she oversees a couple of virtual assistants in the Philippines. So we've been working on that and leveraging that because, that's just a fantastic way to scale and get more out of our team. So that's kind of the investor relations angle with a. Sorry, I'm rambling on, but we've got the investor relations with my sister. We've got director of business development, which is actually a good friend of mine from back home as well. So we're keeping it all in the family. So he's just an amazing salesperson that's very attentive, and he's kind of like that first line to reach out for capital and stuff. Like I said, you need to have somebody full time on the team, and thankfully we've got that in abundance, and we're looking just to continue to expand that. And then my business partner, he runs the more operational side of things. As I mentioned earlier, he was formerly a tax attorney, so he's got that legal mind, dotting the I's, crossing the T's. So all the legal stuff he handles and operations, asset management. He oversees the management team down in Houston. And he also oversees our asset management team, which we have a director of asset management and an asset manager that sit in our office as well. So, I mean, I kind of rattled off a lot of things, but it's quite lean. And that's what I love about this business also is, we're just getting started. We'll definitely scale the portfolio to $1 billion, $2 billion, $3 billion, $5 billion, hopefully. And I don't think the team needs to grow that much to do that scale,
Awesome.
right? That's the beauty about this business. It's so scalable.
That's amazing. That's amazing. I noticed that you raised some institutional capital recently. Who was your institutional partner?
Well, we're actually doing an exciting deal right now where I don't think I can actually name that partner. But in the past, I mean, publicly we can talk about our relationship with Flagship Capital.
Okay.
That's a deal that we've bought and sold with them, which was an amazing success, and they're a fantastic partner to work with. They're also kind of a great example of a small shop that does a lot. They don't have a big team, but they're everywhere. They're so knowledgeable about the market. They provide debt and equity, so they just have such a well-rounded understanding of the business because maybe they don't like a deal on the equity side, but they do the loan, right? And or maybe they would prefer actually to partner with us on the equity side. So in this case, the deal we did a JV where they partnered with us on the equity side, and that was our first kind of institutional partner, where we learned so much working with them. And that's one of my favorite things about working with institutional partners, whether it be a family office or a private equity firm, because they're not another cook in the kitchen, right? They're not trying to get into your operations, but they have so much experience and insight that they can share that it's super valuable.
So you would say that working with institutions is beneficial because I've heard from a lot of people that working with institutional capital is just a pain in the neck, right? Their due diligence is incredibly thorough. And I guess for the most part, they're not breathing down your neck after things close and if you're executing on the business plan, but that getting it off the ground to the point where they actually write you a check is incredibly difficult.
Yeah.
Can you just kind of like name some pros and cons, I guess, for institutional capital versus, I don't know, working with a co-cap GP or an accredited investor?
Yeah, sure. So you're absolutely right. I mean, due diligence and that whole process is much more rigorous, which I think is a good and bad thing. When you're earlier on, I think it's a good thing because it'll expose a lot of things that you need to work on and a lot of things that you should have prepared on your own. So one of our philosophies is let's take what we learn from our institutional partners and then let's apply it to our retail investors, right? So we don't work with our sophisticated institutional partners in a certain way and then dumb it down and treat our, accredited investors differently. That's kind of our thing, is like we want to be that sophisticated option for accredited investors, right? So that's for some investors that's great. Other people, it doesn't resonate, and that's okay. Like that's just what we've chosen as our niche. But yeah, so the con for sure on the institutional side is more due diligence, little bit, definitely more work on that front. And then the biggest con, because I don't think that's that big of a deal. If you have the right team and expertise, the DD's not a big deal. The big deal is the cost, right? Institutional investors, they pay lower fees, and they don't let you charge as big of a promote, right? So your waterfall is less rich and your fees are less rich. So that's something that as a company and for your strategy, you just have to decide for yourself. Is it worth it to get $10 million in one check, $20 million in one check in exchange for lower margins? Or would you rather bring in 100 investors and syndicate and get higher margins, right? Both are valid, and we do both, and I think both are amazing. So I'm not necessarily looking down the road and thinking to only do one or the other in the future. I like being able to utilize both because it makes us more nimble, where we're able to, let's say, there might be a certain deal that an institutional group likes, but retail investors don't like. So we're able to do that, or vice versa, right? So it allows us to do more deals as well as different types of deals.
That's great. That's great. Thank you. You live in New York, but you invest strictly in Texas. Can you talk about why you decided Texas and not the neighboring markets?
Yeah. So for us, it was a pretty straightforward decision. It's not like we had this big research project where we were identifying the best markets. We were, like, as I mentioned, my business partner and I, we were in Joe's mentorship group. A lot of people were Texas focused in that group to begin with. Joe had about 5,000 units in Dallas at that time, I believe. So it was a very natural place for us to start. So that's really it. The other big component was the fact that a lot of investors feel comfortable and want Texas exposure.
Yeah.
Whether they're on the East Coast or in California, a lot of money has been and continues to flow to Texas. So when you're thinking about markets, there's big markets, there's small markets, there's markets that are easier to buy in or easier to manage in. One of the biggest fundamentals is there's markets that are easier to find good deals in, but it's harder to raise capital. And then there's markets it's hard to find good deals because it's so competitive, but all the capital wants to be there. So as a sponsor, you have to make the decision, do I want my job to be harder on the capital raising side, or do I want it to be on the deal finding side? And so we've chosen, let's make our job harder on the finding good deal side. Let's be in a competitive market, but let's make it easier to raise capital, right? Because it's not a hard conversation to say, hey, we have a deal in Dallas, right? Investors are excited. But if you said, hey, we have a deal in Dayton, Ohio, sorry, Dayton, it's just harder, right? Yeah. Investors are going to be a lot more skeptical, and it's going to be harder to convince them. So that was our Texas thesis.
I mean, so that I guess that probably speaks to your ability to find good deals. And I know you're head of acquisitions, right, for your firm. So, competitive market, probably one of the most competitive markets, right, in the country, with the exception of some maybe Florida towns, right? So how are you separating yourself from the competition? How are you finding these deals?
Yeah, it's very tough for sure. And one of the things we talked about was earnest money deposits and going hard and trying to position ourselves as the best buyer amongst the crowd. Because even if you are at the top price, that doesn't guarantee you the deal. Right. I mean, I remember a heartbreaking deal. We really wanted this deal, and we were willing to pay the top price. I mean, we came in with the best offer. But unfortunately, the seller chose a buyer that they had previously worked with. They had the familiarity, they had the comfort, so they felt that there was more certainty of execution there, even though we were willing to go hard and we had a better price. So, it's that competitive. It's that tough. So for us, it's been a process over time of developing our relationships and reputation in the market. So, and it's really not any more complicated than doing what you say you're going to do.
Yeah.
Right. If you brokers, they want certainty of execution just as much as the seller, because brokers, they want to make their lives simple. They want to make a marriage between buyer and seller, and they want to collect their commission, and they want to move on. They don't want headaches. So we try to position ourselves as the headache-free buyer. We want to make sure that we're pleasant to work with. Even the soft things like just being nice, right? All that does matter. So as far as like the real nitty gritty, I think earnest money deposits, being aggressive on those moves the needle. As far as uncovering opportunity, it's really all about, it's a numbers game to an extent, right? And being patient. So on average, we look at like 100 to 150 deals to acquire one. And you hear that tossed around a lot in the industry. Oh, it's the 100 to 1 rule and stuff like that. But it's true, right? And it just really does take that work. And here's the extra thing too, because if you are looking at 100 deals, but 20 of them are in Phoenix, Denver, Dallas, Raleigh, like you don't know what you're looking at, right? So you might be picking the one out of 100, but that's not necessarily the best one out of 100, right? Mm-hmm. So the key is the fact that we know our market so well, and we have relationships in these markets that we feel very confident that we are picking that best one deal out of the 100, right? Because we know what we're looking at, which makes us more efficient and better at our underwriting, and also better at deal sourcing, which I think there's a lot of talk in real estate in general about like finding the hidden gem, finding the off-market deal or direct to seller and stuff like that. And unfortunately for our business, where we're buying deals that are $20 million, $40 million deals, there's really no secret. There's no true off-market. I mean, if it's off-market, the broker's still taking it to their 3 to 5 favorite buyers for the deal, right? So everything's competitive. There's no magic hidden direct to seller financings type stuff. So it's more of just kind of like just beating against that wall every day, trying to find the right fit.
So, no, thank you for that. I'm noticing that the larger the deal size, the more you just, it's all coming from brokers. Some of them are listed, some of them are not, but it's a numbers game, and you just have to stay massively consistent. And ideally, get really efficient in your market. Understand what rents are going for, so you don't have to do rent comps for every single deal. Understand where cap rates are, and so that's a really, really good point.
And reputation, right?
Yeah,
and then doing what what you you say you're gonna do and performing.
Yeah,
and all it takes is one deal to go sideways where you screwed someone over, and you'll never work with that person again, right?
Right. I do have one last question for you. Texas has been getting all the hype. Every single time I go to a real estate conference, Texas is where it's at, right? But for some reason, there's a ton of non-performing loans. It looks like there's plenty of foreclosures on the way. And what shocked me, I said, Texas, I mean, it has such strong rent growth. There's strong cap rate compression. I mean, the demographics are pushing for Texas being the place you want to invest in. What happened? Why is this happening?
The reality is you cannot have rent growth that outruns interest rate increases, right? So we've seen over the last year or so the fastest rise in interest rates in history, right? And that is impacting the market, to say the least, right? And it's only the very beginning. Like you said, there's been a couple big name foreclosures or big headlines, but that's just the start. I mean, there's going to be a lot of more stuff that comes down over the next year or so as people kind of burn through their liquidity, rate caps expire, loans mature. There's going to be cash in refinances. There's going to be some stress. There's a lot of liquidity in the market, so things are going to get mostly worked out, in my opinion. But still, with this big of an increase in interest rates, it doesn't matter if your NOI went up 20%. If your interest rate is doubled or more in many cases, and value is down 20%, it's going to have an impact. So I'm not sure if there's something specific going on in Texas that's making it more exacerbated. I mean, maybe my one thought could be maybe lending got more aggressive in Texas because people were so excited and bullish. That may be true, but I think that's marginal. I don't think that's a big thing because, I mean, from what I saw, we were seeing 80% bridge loans across the country.
Yeah.
So, but you know, the headline Houston foreclosure on the big multifamily portfolio, that was more than 80%. It was like 80% leverage, and they had preferred equities. They were levered up to like 90%.
Got it.
That's a big recipe for disaster.
Why do you think that got so much traction? That the syndicator that failed, and I think it was in Houston,
That's right, yeah.
and like that was everywhere. But like, I mean, I'm sure that happens pretty often. I can't imagine they're the first syndicator to go bust recently.
No, and we had to answer so many questions about that because we're the Houston guys.
Yeah,
right?
you're the Houston guy.
Our investors are asking us, what does this mean for the market? What does this mean for your deal? Should I invest with you now or
Right.
what? You know, so we answered a lot of those questions. I put out a video on LinkedIn about those foreclosures as well. I mean, that situation was just basically the poster child, if you will, of everything that's going on. And I don't think that, I mean, are they villains? Are they bad people? Like, no, I don't think they're bad, but they just got caught with the market. The market changed. They were in a very levered position. And when you're levered for good times to be even better. But when bad times, it's going to be even worse. And we, like everybody else, we got carried away with the leverage. We were using bridge loans and, we were a part of the aggressive market. That was the zeitgeist. And so we have definitely, going through that experience and now going through what we're going through now, which is kind of hunkering down, making sure that the portfolio is safe, refinancing into long-term debt, all that good stuff. This has definitely taught us a very, very valuable lesson that, hey, the market really does change. And these foreclosures, like these things can happen. You can lose money. So it is best to not stretch for that 18 or 20% return. It's better to be more conservative, sleep well at night, have a more conservative deal structure.
Yeah, my mentor always says this: get rich slow, sleep well at night, and that's what it comes down to.
Rob, you're a stud, man. You're a stud. Everything from the hair to the sunglasses in the pocket, dude. You're a beast. You're 26 years old. You're killing it. What's next for you guys? What's the goal?
Well, speaking of the what we were just talking about, I think survive to 25 is definitely a good mantra. We're doing well. Our portfolio is performing, but I think there's still trouble ahead. So survive to 25 is first and foremost, right? Let's protect investor capital, and let's continue to find good deals. And then, over the next couple of years, definitely I'm chasing that billion. That's a big, big goal. We want to get to $1 billion AUM. And from there, I don't know. I don't have a big master plan, but I think, when the first billion is probably easier than the next one. So get to 1, then maybe get to 2 and see what else is exciting.
That's amazing, dude. I personally learned a lot. This was an awesome conversation. Where can people find you? Where can they download your underwriting model? Where do they go?
Yeah, you can learn more about us at Lone Star Capital on our website. We actually just did a brand new website redesign, so super excited to share that. You can find that at lscre.com. So that stands for Lone Star Capital Real Estate. So lscre.com. And on our website, like you mentioned, you can get the free underwriting model download, find some other resources from us, and also get in touch.
One more question, just drop it in before the end here. Rob, there's going to be blood on the streets in the coming years. And R.I.P. Sam Zell, the grave dancer. There's going to be a ton of opportunity, I'm sure, in Houston and Dallas as well. What are you going to do to capitalize on this opportunity to get to that $1 billion mark?
Yeah, sounds simple, but it's harder than it sounds, right? Grave dancing and everything, because the way that markets work is when the best deals are out there in the market, right? When there's blood in the streets, that's precisely when sentiment is the most negative. And what that means is it's going to be the hardest time to raise capital. So right now I'm telling my team, because I'm sure you guys have seen this and have seen other people talk about how it's getting harder for them to raise money right now, as opposed to, let's say, a year ago. And, we're hearing that from our partners as well. The reality is what I'm telling my team is it's going to get worse before it gets better. It's going to get harder to raise money before it gets easier, in my opinion. I think that sometime in the middle of 2024 or something, sentiment's going to be quite negative, and it's going to be very hard to raise money. So, and that might be when the best deals are available. So everything that we're doing every single day to continue to build trust with our investors is exactly what we need in a time where it's going to be the toughest to raise capital. We're going to say, no, this is a good deal. I know times seem uncertain right now, but this is the time to invest. So it's all about having a strong enough relationship with your investors and the trust, and then also having different kinds of investors, because if you have the right, maybe family office or institutional kind of investors that are more savvy, more patient, more opportunistic, those are going to be the people that are going to be more ready to jump in when there's blood in the streets.
Awesome.
Great answer. This was a great podcast. I love this. We appreciate everything, your insight. Thanks for coming, and safe travels.
Thank you very much. Thanks for having me.